it begins every question and ends every sentence in conversations with clients these days. And in fact, it's morphed into the stagflation conversation, which we think is a little bit overblown at this point. Frankly, for stagflation, you need high and persistent inflation, as you know. You need high unemployment, which at 4.8% probably is higher than pre-pandemic, but not terribly high. And most importantly, you need stagnant or declining demand. And demand is not a problem for this economy. In fact, demand is what is part of what's agitating and aggravating the supply chain issues. So we think you have sticky inflation, persistent inflation, put whatever descriptor you want on it, but it's here to stay for a while. So far, it hasn't tipped the capital markets over, though. I mean, if you close the year down right now, you'd have the S&P 500 up almost 20% for the third consecutive calendar year in a row.
Somebody asked me, not that anybody cares what I think, but they asked me anyway, what I thought was the greatest market risk. It was at the Market Rebellion Conference in Vegas. And I just said, I think and I held a poll of the audience. The greatest market risk to me is that about 40% of financial advisors or money managers have never managed money in a rising rate or inflationary environment. I mean, we haven't had one in 15 plus years. So if you got out of college, you're 37, 38, you've never managed money or invested in a rising rate or inflationary market. It's a different beast.
It is a different beast. You're exactly right, Brian. I think that's an excellent point. It's been made, as we've talked about, kind of these fits and starts with interest rates going up over the years many times. The reality is, though, I think what people get hung up on is, what should I do with my portfolio? If you go back and time test this into high or sustained inflationary environments, or even stagflation environments, although we don't have many time slices to take on that, it's interesting because the same assets do well in that type of environment. It's things like real assets, it's real estate, it's commodities. Actually, volatility does really well and cash does really well. What doesn't do well? Naturally, bonds don't do well. Credit doesn't do quite as well, right? And even equities positive returns, they languish a little bit in that type of environment.
So, we just talked about Alcoa. Numbers were solid. Stock's up like, I think, 300 or 400% this year. So what do? Do we buy industrial companies that make stuff, real estate investment trusts, and keep the rest in cash?
Well, no, I would say we definitely put a lean on to cyclicals. It's interesting, if you look at S&P cyclicals versus defensives, they're back to year highs now. So you remember through the summer months when the cyclical trade fell out of bed, and it was not performing well at all as growth took over, as bond proxies took over. Now what's happened is cyclical has reasserted itself on this idea of rising rates. I think one of the biggest risks, to your earlier point in question, is the bond market still hasn't priced in sustained inflation. And everybody worries about a Fed taper, and rising rates. What happens when the bond market wakes up some morning and decides, hey, inflation is here to stay for a while, and we need to price in an inflation term premium to the yield curve?
Well, what happens if that happens?
Well, if that happens, you're going to have the whole curve shift higher, and you're going to have it continue to steepen, which actually does really well for things like financials, which we're right in the heart of seeing the big bank earnings seasons. You can imagine that would just light their fire. It does well for asset managers. So there's sectors that really work and areas of the portfolio that really work on the equity side when you get a rising and steepening yield curve.